You're in tune to the Paperflip Real Estate Podcast.
So you got that down payment ready to buy that brand new home. You thinking, yeah, I'm all set, I'm ready to go. Well, why you might need to save beyond that mortgage down payment for home buying is the discussion for today's topic. So let's get into it. So you did it. You climbed the mountain of paperwork, survived the lender meetings, and passed the credit checks with flying colors. You holding that pre-approval letter and you thinking, hey, the hard part is over, right? You already found the perfect house. You know exactly where the sofa is going to go, and you can practically feel the keys in your hand. But what if I told you that getting the mortgage wasn't the finish line? And what if it was just the entry ticket? And what if that big shiny purchase price you've been laser focused on is just the first chapter of the story? See, there's a whole universe of hidden costs that your mortgage lender might have conveniently glossed over. These are the expenses that can turn the dream of home ownership into a financial migraine, a big headache, trapping you into that dreaded house poor zone where you own a beautiful home but can't afford to actually live in it. In this video, we are pulling back the curtain on the true costs of owning a home. I'm not here to scare you, just here to prepare you. We're going to break down piece by piece the savings you absolutely must have in your corner beyond that mortgage. Think of this as your playbook for buying a home with total confidence, ensuring it stays a blessing and not a burden. So let's get into it. So I want to start off talking about this sneaky duo, which is called property taxes and homeowners insurance, those two. All right, so let's start with two costs everyone knows exist, but almost everyone underestimates, and that is property taxes and homeowners insurance. Now, most people see them bundled into their mortgage payment in an escrow account and think, hey, great, one less thing I got to worry about. But that's a real dangerous way to look at it. First off, property taxes. These are what your local government, your city, your county, or your school district, this is what they charge to keep the lights on. The rates are all over the map. Now, in a state like Hawaii, you might pay around 0.27%, but like in New Jersey, it's more closer to 2.2%. Now, on a $400,000 house, that's the difference between paying about $1,100 a year and nearly $9,000. And here's the kicker: this number isn't set in stone. Now, your home will be reassessed, and if that value has gone up, your tax bill is going right up with it. That predictable payment you love can suddenly spike by hundreds of dollars a month. Then you got homeowners insurance. Your lender demands it to protect their investment, but you needed to protect yourself from a disaster. Now, the national average is pushing around $2,500 to $2,800 a year, and it's climbing fast. And states prone to hurricanes and wildfires, rates are already through the roof and rising even faster. So what do? An escrow account is a great payment tool, but it's reactive. Your lender estimates your cost for the year. Now, if they guess too low, which does happen, you get hit with an escrow shortage. So that means simply you have to write a check for the difference, and your monthly payment goes up to cover that bad guess. To avoid that gut punch, you need your own financial firewall. Before you buy, research the home's property tax history and get multiple insurance quotes. And once you own it, take your annual tax and insurance bills, pad it by 10% for future increases, and divide that by 12, and save that amount in a separate high yield savings account every month. If escrow falls short, then hey, you got the cash. But if not, you just tricked yourself into saving more money, which isn't a bad thing. Don't just trust the bank's math, but build your own buffer zone. So let's talk about the down payment fine, which is private mortgage insurance, or PMI. Now, next up is an expense that just feels like a penalty for not having a massive pile of cash lying around. Now, private mortgage insurance, or PMI, if you put down less than 20% on a conventional loan, your lender makes you pay for it. Let's be perfectly clear here. PMI is insurance that protects the lender if you stop paying. It does absolutely nothing for you. That's the homeowner. You're paying a premium on a policy where they are the only one who can cash in on it. It's easily one of the most frustrating costs in home buying because you're pouring hundreds of dollars a month into something that builds zero equity. Imagine two friends buy identical $400,000 homes. Now, one puts down 20%, let's say $80,000, and their mortgage is around $2,200 a month. The other one puts down 5%, about $20,000. Now, their payment is probably closer to $2,600 because of the PMI, the private mortgage insurance. That's an extra $400 a month just vanishes, all because they started with less cash. So the strategy, well, get rid of PMI as fast as humanly possible. The first way is to pay your mortgage down until you owe just 80% of the original purchase price. You can formally request this removal at 80%, but they legally have to drop it at 78%. But the second and often faster way is through home appreciation. Let's say after 2 years in that $400,000 home, market goes nuts, goes bananas, and your home now appraises for $500,000. Your original $380,000 loan is now only 76% of your home's new value. You can officially request to have the PMI removed. You have to pay for a new appraisal, but a few $1,000 is a bargain to save thousands in future PMI payments. The key here is to be proactive. Track your home's value, know your loan balance, and make the call the second you hit that magic number. So let's talk about the silent budget killer. Silent budget killer, which is routine maintenance. You've been a renter, you know the drill. Leaky faucet here and there, you call the landlord for that. Gutters clogged, not your issue, because you're renting. But when you own the home, you are the landlord. Yeah. Every little job is now your responsibility and, most importantly, your expense. This is routine maintenance, and it's a silent, relentless drain on your wallet if you're not ready for it. Now, I'm not talking about a tree falling on your house. I'm talking about the never-ending to-do list that keeps your home from slowly falling apart. Like annual HVAC servicing, pest control, lawn care, gutter cleaning, power washing the siding, recaulking the showers. Individually, they sound manageable, but together they add up to thousands of dollars a year. This is where the golden rule of home ownership comes in, the 1% to 4% rule. Financial experts do agree you should budget and save between 1% and 4% of your home's value every single year for maintenance and repairs. Now, on a $400,000 home, that's $4,000 to $12,000 a year. Yep, let that sink in for a minute. That's an extra $333 to $1,000 a month on top of everything else. And studies show the average homeowner easily spends over $6,000 a year on just this kind of stuff. So the solution is to stop thinking of maintenance as an unexpected surprise and start treating it like a bill. Create a dedicated savings account. You can call this your home maintenance account. The same day you pay your mortgage, have a automatic transfer going to this account. Now, for that $400,000 house, maybe you start with 1.5%, which is $500 a month. When the $400 HVAC tune-up bill comes, the money is just sitting there in your account. This one habit transforms maintenance from a source of constant stress into a boring, predictable line item in your budget. Okay, I know we're throwing a lot of numbers at you, and it can feel like a fire hose of information, but our goal is to empower you, not overwhelm you. If you finding this breakdown useful and want to keep getting smart about your money, do me a huge favor and hit that subscribe button. We drop videos every week designed to make personal finance simple and put you in control. Now let's talk about the inevitable crisis, the emergency repair fund. Okay, so now let's get into routine. Maintenance is a bigger, scarier brother, that emergency repair. And this is a total different beast and needs a totally separate savings fund. Maintenance is predictable. Emergencies are sudden, expensive, and you can't ignore them. They're not going anywhere. And they do happen. Emergencies come up unexpectedly. This is the AC unit dying in the middle of a 100-degree heat wave. This is discovering a massive roof leak after a storm. This is a plumbing disaster that's flooding your basement. These aren't, I'll get to it later, problems. A major roof repair can set you back $1,000 to $6,000. A new HVAC system can easily cost anywhere from $7,000 to $12,000. A serious plumbing fix can run into the thousands as well. So this is why your general emergency fund might not be enough. You need a dedicated home emergency repair fund. Now, this account is what stands between a broken water heater and a mountain of credit card debt. So you say, Lloyd, how much? And the rule is similar to an additional 1% to 3% of your home's value set aside just for these big ticket disasters. For our $400,000 house example, on top of your maintenance fund, you need another account with $4,000 to $12,000 in it. And maybe many people just aim for a nice round number like $10,000 as a starting goal. Now here's a pro tip. Your home inspection report isn't just about pass and fail. It isn't just some kind of document. What it actually is a treasure map for your future problems, things that are coming up. So if the inspector noted the HVAC is 15 years old and the roof is looking rough, you already know what your first emergencies are likely to be. Using that report to prioritize your savings. Now, this fund isn't for if something breaks, it's for when it breaks. It's your ultimate peace of mind. And you're going to need that. Things are going to happen. So let's talk about this sneaky expense multiplier. Sneaky expense multiplier, which is utilities and HOA fees, or homeowner association fees. Now, when you move from a cozy 900 square foot apartment to let's say a 2,000 square foot house, your bills don't just go up, they end up multiplying. The two most unlimited culprits are utilities and HOA, or the homeowners association fees. So first, let's deal with utilities. It's not just that you have more space to heat and cool, you have more lights, you have an electric water heater instead of gas, and you're now watering your lawn. It is shocking how easily your combined electric, water, and gas bills can double or even triple in some cases. Solution is just simple homework. When you buy a house, ask the seller for the average utility bills from the last year. And this gives you a real world number for your budget, not just some wild estimated guess. Now let's talk about them HOA fees. Now, if you buy a condo or a townhouse or in certain neighborhoods, you basically joining a club with mandatory dues. These fees cover things like community pools, landscaping, and trash removal, things like that. Now, the national average is around $200 to $400 a month on HOA fees, but in some high amenity areas, it can go past $500 or even $1,000 a month, really. And real danger with HOAs is their special assessment. This is a massive one-time fee charged to everyone when something big breaks that the HOA savings can't cover, like the whole community needs a new roof or something like that. Suddenly, you could get a surprise bill for several $1,000s. It can't happen. But before you buy, you must investigate HOAs. Ask for their financial documents and read them over, especially their budget and reserve study. A healthy HOA has fat savings account for future repairs for when things like this come up. Poorly managed one is a special assessment waiting to happen. Budget for the monthly fee, but it's also smart to put a little aside in your own HOA surprise fund. Set up a fund for that as well, for the HOA. Now let's cover the ticking time bomb, which is appliance replacement. Your beautiful new home is filled with expensive equipment that started depreciating the second it was installed and put in. Like your fridge, dishwasher, washer and dryer, water heater. They all have a finite lifespan. Think of it as a ticking clock over every major appliance you have installed in that home. Now, a fridge might last 10 to 13 years. Dishwasher, maybe 9. Washer and dryer said it'll run you 10 to 14 years. You can get that much out of it. Now, what happens when they decide to retire all at the same time, all in the same year? New fridge can be around $1,500 to $2,500. And a washer and dryer set run you about 2 stacks of $2,000. New water heater install, that's another $1,500. You could be staring down a $5,000 to $10,000 bill just to make your house run operable again. And this is where a targeted saving strategy is your superpower. You create an appliance sinking fund as well. Sinking fund is just a savings account for a specific future expense that you know is coming. So here how it works. Make a list of your major appliances. Note their estimated replacement costs at their particular age. You can find average lifespans with a quick search. Subtract the current age from the expected lifespan to see how many years you got left. Then divide the cost by the number of months remaining. Let's say, for example, a new dishwasher is $800. Yours is 5 years old with a 9-year lifespan. It gives you 4 years or about 48 months that's left on it. You save $800 divided by 48, which is around $17 a month just for dishwasher. Do this for every appliance you got in the home. The total might be $75 to $100 a month. By doing this, you turn a future crisis into a boring, manageable expense. When the dishwasher finally dies, you won't panic about it. You just buy a new one, stress-free. Here's the final boss, the upfront and one-time costs. So finally, let's get into this giant pile of cash you need at the very beginning. Money that has nothing to do with your down payment. These are one-time costs that ambush you before you even unpack a single box in the house. The biggest chunk is closing costs. These are all the fees for finalizing the loan and transferring that title. They typically range from 2 to 5% of the purchase price. So on our $400,000 home example, that's an extra $8,000 to $20,000 in cash you need at closing for things like lender fees, appraisals, and title insurance. But hold on, here's some more. You have moving expenses, which can cost thousands, whether you hire pros and basically do it yourself with a U-Haul truck. You want to change the locks immediately when you get into your new home. That's a few $100. You probably need new window blinds or curtains, which can cost thousands for a whole house. And of course, there's furnishing this larger space. Your apartment sofa might look like doll furniture in your new living room. So you want to upgrade and get some more furniture. This money needs to be saved and liquid before you can close, and you need to be able to touch it and be able to get it immediately. And this cannot come from your emergency fund. That needs to be protected for after you move in. And so while you saving for your down payment, you must also be saving for the closing and moving fund. And it's a dedicated fund, $15,000 to $20,000 or more, separate from your down payment. And it's what allows you to start your life as a homeowner on solid ground and not in a financial hole. And it's imperative that you do so. And these things that commonly don't come up in discussion with your lenders, and some thorough lenders will. They may cover that with you. So, have you considered how much it's going to take for moving expenses and things of that nature? So let's bring it all home here. So that mortgage payment is just one piece of a much larger financial puzzle. To be a truly secure and successful homeowner, you have to plan for all these things. And you need a buffer for taxes and also insurance, and a strategy to kill that private mortgage insurance. A monthly savings habit for maintenance as well, and a fully loaded emergency fund for disasters. A smart budget for handling utilities and homeowner association fees, and also a sinking fund for your appliances, and a huge upfront stash for closing and moving costs. Now, I know it does sound like a lot, and it is. But the point of this whole topic isn't to talk you out of buying a home. I'm not trying to do that. Just want you to be aware, and basically just to arm you with the knowledge, do it the right way. Being prepared for these costs is one of the single biggest differences between people who build wealth with real estate and people who end up getting crushed by it. This is how you avoid being house poor. I want you to start out that way. And this is how you make sure your home is a source of joy and not a source of regret. Now you had a playbook, and you know you can do this. So we covered a ton of ground today in our topic, and I really want you to comment. What is one of the hidden costs of home ownership that surprised you the most out of this discussion? Or what are you most worried about as a future home buyer? Drop your story or your questions in the comment sections below, and let's build a community of smart homeowners and learn from each other. Trust me, I've been there and know all about it, and these things do come up. And I just want you to be aware and be real smart about home ownership. And as always, want to thank you for checking out the channel. If you got any value out of this, hit that like button and subscribe to the channel for more content to make you a lot wiser and a wealthier homeowner. Catch you on the next one. This has been Lloyd for Real Estate.